on the 31st. Happy Halloween. It's going to be an interesting week. We have a big week ahead with 1,000 companies plus reporting earnings, and all eyes on the Fed Wednesday, 2 p.m. with FOMC rate decision and press conference. Let's dive into the risk disclaimer. We understand risk in trading. Please and always use trade capital only. Do not trade with money you can afford to lose. Whether trading stocks, options, futures, forex, cryptos, you know the risks. If you're following me out there on social media, make sure it's the real me. This week we're gonna have a bonus session. We're gonna do Monday today, Pulver report. Wednesday at 2 p.m. I'll run a live session for the FOMC rate decision. So feel free to jump in and digest the news with me and trade. That'll be Wednesday at 2 p.m. Eastern time. And Friday, a little recap at 9 a.m. That's all on youtube.com/Chris Pulver. Facebook, Instagram, Twitter, Twitch, TikTok, at Real Chris Pulver. If anybody's sending you messages, it's probably not for me. Make sure it's the real me. Okay. All right, let's jump into the charts. Hang on a second. Oh, I messed up my screen here. Hang on one second. There we go. We need this screen. There it is. All right, and I'm going to get logged into the YouTube channel and say hi to everybody. Off we go. All right, all right. Perfect. All right, Herbert's here. Good morning. Gary, good morning. David, good morning. Chris, good morning. Gail and Donna, good morning. Nice to see everybody this morning to kick things off. And we're going to dive right into the SPY, the dollar index, oil, gold, silver. We got our news this week. Like I said, 1,000 plus companies reporting earnings. Those include some notables. Let me see here. Just took a screenshot of this last night. Notables for earnings this week. We have Uber, SoFi, Robinhood, Roku, Square or Block Inc., PayPal, DraftKings. Almost 1,100 companies reporting earnings this week. Last week was 700, and the big miss was in tech. Fortunately, Apple kind of kept things afloat because the SPY rallied last week. In fact, off this CPI kind of future CPI low, as I'm just kind of coining it here the last couple weeks, that was the market's kind of overreaction early to the CPI data, and we've rallied since. Again, Q4 expecting a rally, expecting kind of the Hail Mary to see if we can salvage the market fighting off these lows to finish the year. But you know what's interesting is we came right back to 390, which if you recall back in August, September, I had many sessions live and trading room sessions that we talked about the importance of this 390 level to break. So we were bearish going into this 390 break that paid pretty nicely. We've been bullish since the CPI data the last couple of weeks. That's been pretty solid as well. And you know, for the most part, we're just continuing to navigate this potential corrective channel. We might see the upside. You know, if somehow the market's going to look at the Fed with a softer language this week, then perhaps the market gets a little bit of a rally up towards 400. But at 390, because it's such a critical spot, we could also be heading right back down to where we started. And 390 continues to be kind of a pivot. What the heck, dude? Get out of here. All right. Volume is super low. Maybe it's on my side. Maybe it is on your side. I'm looking at it's pretty loud on my end. I'm like pushing the yellow decibels. I can turn it up a little bit. Let me see if I can adjust this. See if that'll make it any different. Slightly higher. I'm getting into like yellow and red on my little decibel deal, so that should be pretty loud. Okay. All right, so that's the SPY. Let's talk DXY for a moment. Dollar index. Dollar index trading at 11138. The last couple of months, really. Chart alarm set above 115. Chart alarm set down here at 107.60. Just be aware that the dollar index may still run. It looks like my upper level chart alarms expired. So I'm going to reset those 115. Here's the low at 107. I'm going to set chart alarms here at 116, 117, and beyond. Really all the way up towards 120. So we go 116. Chart alarm set there. 117. And we'll take a look at that Fed watch tool here in just a moment as well. 118. 119. And 120. So setting chart alarms to the upside just in case. If we hit the downside, that's a good thing. Do you notice the correlation we've seen the last couple of weeks? You know, the SPY's been bullish, the markets have been up for the most part, and the dollar's been weaker. So we go back to the last 2 weeks, the dollar has declined from almost 114 down towards 110. That 400-point move in the dollar index is translated into a nice little rally in the SPY. So we still need to see that. That's my belief correlation-wise is we need to see at the very least the U.S. 2-year yield. The 1 year, the 2 year. Look at this. This is going to be a rough week if equities are going to see a higher 2 year. We also had a gap higher. So if the 2 year gap's higher, this is the 2 year bond yield. If we get to 4.8 or we drop to 4.2, those are my chart alarms. Remember, the Fed watch tool is expected to be around. The market's expecting a 75 basis points hike for this week. So it's right here. I don't know why that's so large, but anyway. High probability, again, 75 basis points hike expected for Wednesday. Again, join me live on the YouTube channel, 2 p.m. We'll be live for the FOMC, just looking at the real-time news. What do they do with the rate? Jerome Powell's press conference at 2:30. We'll kind of take some of the headlines and talking points from that. And more importantly is we're going to watch price action. Okay. I've been hearing a lot about prop firms lately. I'm not ready trading yet. Prop firms, as in like third-party funded forex trading. I mean, it's good. I mean, it's a way to seek third-party funds, so you're not forking over $100,000 plus to your own account. But you have to check the requirements. What is the leverage that you're offered as a trader? What is the drawdown percentage? A lot of those prop companies and prop firms have super strict drawdown requirements. And so the equity management needs to be on friggin' point. That's the most important thing is you have to know how small to trade. You have to know how tight to trade. You have to know what kind of strategies to deploy. A lot of those programs do not offer amazing flexibility as far as I could just build a position and casually get in and it's dollar cost average. No. Those never work. A lot of those firms require every time you place an entry, it has to have an attached stop loss. So that's what I'm saying. And just check the leverage, check the margin requirements. Sometimes you have better permissions. Like I know some U.S. traders that traded prop firms, they can trade non-U.S. permissions, which is great. So there's pros and cons, but just make sure you do your homework, a little bit of a due diligence, and just see if it's right for you. That's my take. All right, so Fed Watch tool, 90%, nearly baked in. But again, the market's been rallying on the thought of this move. So we have 75 basis points expected for November. I believe another 50 basis points. So this keeps jumping around. So 50 basis points where, this is 50 basis points here for December. This is 75 basis points for December. You see it keeps going back and forth. We've seen the higher probability here, and then it shifts to here, and so it's back and forth. And this is probably going to change again this week. So based on Wednesday's decision and Wednesday's session, we'll keep an eye on this kind of real-time update to see where the Fed is being priced in for December. And then another probably 25 basis points for February. Okay, and then in March is anticipated to be a pause. So the language in which the Fed comes out with on Wednesday, we'll see if that makes sense and that matches what we're talking about here, or if it actually is a shift more hawkish or a shift more dovish. We've seen two central banks not raise rates to the point that they anticipated. So the RBA was supposed to go up 75 basis points, and they came up 0.5. The BOC last week, this is the Bank of Canada, they're supposed to go up 75 basis points. They came in 0.5. The ECB raised rates 75 basis points, but they had a very dovish tone, and the euro got hit pretty hard last week. So I just read this morning that inflation data of the Eurozone is above 10%, so that's probably not boding well for the euro. Speaking of, here's a currency strength chart really quickly. And we have pound and yen on the bottom. We have dollar on top, vertical axis, 60 and 50. So not a ton of volatility, but enough to keep us interested. New Zealand is second. We'll see what the dollar does, of course, this week with the Fed. Everything else is kind of just getting started here for the New York session. But that is that. Okay, what's up, Tony? So like I keep talking about, we have to watch the dollar index. We have to watch these yields. So the 2-year, the 10-year. You can watch the 3-month. So the 3-month continues to make higher highs. This is going to be a pretty critical spot this week. If the 3-month starts to go down, maybe that's the quick start, the jump start towards a weaker dollar. The 3-month goes up. We're looking at again, probably an inverted yield curve. So if I do the 10-year, which is at 4.04, and the 3-month USO3M, I just typed that in a second ago. 4.02. Wow. So we're really close to the 3-month and the 10-year having an inverted yield curve. The 10 and the 2 are like long gone. We have the 2-year at 4.49, way above the 10-year. It's been like that since like April of this year. We've had an inverted yield curve for the last like 5 months. So, I mean, I know Janet Yellen last week said, we're not going to have a recession, or we're not even close to recession, but this is one indicator. 2, contracting GDPs is another indicator. The consumer slowdown, real estate crushing, commodities down, freight down. It's like, pretty sure there's a slowdown. So unless you're just not calling it a recession, it certainly feels like it's a contraction, right? So anyway, but we have to watch these yields, and the correlation is this. If yields go up, more pain ahead in stocks. If yields go down, stocks can start to find some footing and probably cement those lows from that CPI data in September. All right, but we have to watch that. And again, it's just super annoying, but it is the dependency that the market has right now. It is all eyes on the Fed this week. Okay, the JPY. If we look at the 10-year, look at the 10-year yield. Actually, we're still sitting at that 0.25%. It keeps jumping around up and down. We're going to see if the BOJ has some problems with intervention, or if something breaks in the Japanese government bonds. They're spending like $200 billion. It's like 29 trillion yen or something ridiculous like that, to keep protecting this 0.25% level. So it is QE, infinity, and beyond for the BOJ once again. And in the landscape of all central banks tightening and raising rates, that's a pretty bold strategy. As they say in dodgeball, bold move, Cotton. But that's the BOJ. All right, I need to get connected to my notes from last week. I'm going to start looking at some covered calls. I know I have last week in Equities on Demand. Let me bring up Telegram really quickly. So let's do this. Equities on Demand. Oops, don't do that, dude. What is that? I don't want that. There we go. Right here. So most of our expirations from last week, we had profit on IEF. We have some credit spreads. So TLT I took a small loss on. FXI close for profit. Covered calls CLF, FCX, SPWR, KHC, TAL, and F. We're going to look to add additional covered calls either for this week if the premiums are decent, or out for a while, maybe the next month or two, to start chipping away and still continue to lower our cost. CLF, I'm close. I'm trying to get that one called around $15.50 to $16. FCX, we had a cover call at 34. We're trading at 32 and change. SPWR, we're going to have to sit on for a little bit. KHC is actually at highs, and I've rolled that a couple of times and lowered my cost basis by about $1 since I think 2 weeks ago. So more profit ahead on KHC. Hopefully that's a nice defensive play. TAL is China Education. Hopefully get that called away at like 450. It didn't get called away last week. And then Ford, although they've shifted their kind of forward outlook on electric vehicles, Ford has been kind of prepping the market positively, where it continues to kind of rally and stay pretty solid. So there's a lot of trades out there that I think, from establishing some decent lows, establishing a recent high, I would be looking for some range activity here. Energy continues to be a crazy highlight in portfolios. Energy is awesome. So XLE, we're getting some tops here around $90, but this does not stop the fact that earnings have been just killing it for energy stocks. XOM and CVS, I think, is that right? Chevron. So ExxonMobil, well above these highs. We broke out at 105 and continue to go up. I was looking at a bear call spread, but I just didn't want to step in front of these earnings, so I didn't do anything on it. We might take a stab at it this week, but again, it'd just be a bear call spread in case if there was like a massive gap to the upside. There's just not. So I'm not really going to force a short on a company that's probably making healthier profits than some large tech. What is Chevron? Chevron and CVX. There it is. Chevron and CVX both recorded awesome earnings, and I mean, technically speaking, they look like there's some pretty attractive levels to sell. Just in the short term. But we have some stocks we're doing really well with equities on demand. SLB is Schlumberger. This thing has been ripping to the upside. That rally right there was nuts. We went up around 58% in the last 2 months. So we've been loving these credit spreads near these lows. Halliburton is another one, HAL. So a nice little rip from these lows, $24 up to $37. And that is up about 50%. We have some, let's see what other ones, CTRA, hanging in there off some equal lows, REI and RIG. Some other ones have been long in off these lows, from $2 to $3 and change. RIG is Transocean. That's up off the lows, $2 to $3.50. So anyway, we've had some really nice runs on energy, but we're going to take a look at it this week. So XLE is the energy sector. We're struggling here around those highs. We had a long call that we took some profit on. This was up, I think we closed it out for like $1.70, $1.75. So we got a nice little 100% profit there on that position. Certainly not going to complain. And then we have SVXY. We have a $56 long call out to December that if we get another rally up here, if the Fed can kind of, again, for whatever reason, boost the market, if the SPY heads up towards 400, which I do think is possible. Trading up towards 390, can we rip up towards 400 plus? I do. I'm pretty cautious going to that 400 handle, though. I mean, that could be some really nice intermediate resistance. So just be careful. If the bulls are going to take it to 400, I think that's some nice profit protection. And just lots of options. Lots of options, little cash outlay, and just stay really, really flexible. As far as currencies go this week, it's all eyes on the dollar. So let's take a quick look at some of those dollar crosses. Aussie dollar still hasn't broken the trend line, so we need to wait. This may be an inverted head and shoulders, which I would take a look at something like this. If the DXY gets weaker, we might have a bit of a bottom forming in here. Now, this does not mean we buy this, okay? It means that we're looking to confirm the break of the neckline, then we can see bullishness. So I need to confirm a break above 65, 65.50 on Aussie dollar for me to get in. I think there's some nice upside potential on that, though. That'd be a risk on rally. Euro dollar, pretty close to the DXY. We made you can see here, a low to high, higher low to higher high. We're on the right-hand side of the trend line, but again, critical spot this week. Do we use the backside of the trend line to continue to work up with a correction, or does dollar strength prevail this week and drive it right back down? I can't tell you. Look, we've been doing live sessions here Mondays and Fridays the entire year. We're probably, 40 some weeks into the year trading. And I can't tell you how many times this year I felt like we're just doing analysis where it's like, here's where we can go this week or this way. And that's obviously not my favorite analysis. I'd like to have a little bit more conviction going one way or the other, but it's just the dollar and the Fed and the uncertainty. It just forces me to position very neutrally, and we need to be ready for anything. So chart alarms, I'll have to reactivate some chart alarms here. I do have some chart alarms set at 101, 101.50, and 102. But looks like that one to the bottom expired, so I'll set a chart alarm down here. If the dollar does break these lows at 95 and change, I'm still buying it. 95.40, I'll set a chart alarm right there. So 95.40, set a chart alarm there, lows, and that would be dollar index, most likely poking those highs. Pound US dollar, I'm going to see if the pound US dollar can squeeze up towards 120. I'm looking for dips and pullbacks if I can buy it. It'd be something like this. Again, without getting super aggressive, if we just have a little bit of a pullback here, let's see if we can make some higher lows, looking for a trend line break to head higher, or we may see something like this where the market pulls back into an equal level. Something like this, we have more range-bound trading. This could be a low to high, higher low with kind of equal support here on 1.10, and then another pushback up towards 116. I'm ultimately looking for this to head back into, there's a nice monthly pivot back here, past support becoming a resistance. We also have some big pockets. Outer trendline channel resistance around 118. 120 is a nice round number. So I'm going to see if the pound US dollar can head back towards 120. Pound Swiss as well. That's my target on pound Swiss is 1.20. New Zealand US dollar. Similar to the Aussie, the difference here is we did breach these highs. So if we have a left tip, center tip, a pullback, but if we get weaker dollar, I think the Kiwi has some room to run. I would look left in this chart around 6,000. I would look all the way back into any of these highs here. Maybe not a higher, maybe not a higher high, but something between 62 and 6,300, I think are pretty fair. So I'd be gunning for some of these previous highs on the Kiwi, but again, we need to see weaker dollar because of that. And I'm okay waiting. I'm okay waiting for better confirmation. Feeling like the coast is clear. We're gonna have some hopefully sustainable runs against the dollar in the Q4 rally to take us into the holidays. Dollar Canadian, 36.70. This one also looks like head and shoulders. Take a look right here. Left shoulder, head to neckline, right shoulder. So we could look for some right shoulder trading, or we can simply get the break of the neckline, trade this down towards 32. So we either have a 3750 to 3800 sell zone, or we have equal highs around 1.40, which would be a nice little double top to sell, or we break the neckline at 35 and head down about 300 pips. But looking at the dollar crosses right now, a lot of them are set up for what could be a nice little turning point in the dollar with some topping and bottoming patterns. Dollar Swiss, this is my hedge. I'm still long on dollar Swiss. Chart alarm set at 101.50, 102 and change. We got long here around 1.0040 a couple weeks ago as a hedge and flex. So we're long. I'm long euro dollar. I'm also long dollar Swiss. Obviously, if I'm wrong on one, I'm going to be right on the other. So if the dollar gets stronger, dollar Swiss heads up into these new highs. We'll take some profit up here. Meanwhile, the euro dollar, I'll look to buy and kind of fade that move back eventually. But if the dollar Swiss fades to the downside, that's fine. I will stay long in here, and I'll buy again at 95. And then meanwhile, if this drops, my euro dollar and everything else, dollar related should rally with a little correction rally against the dollar. Okay, and then dollar yen. This year's wild card that nobody likes. Pretty much, what's one card? Is this like old maid? What's one card you can get that you just lose? That's pretty much the dollar yen. Unless you're long, of course. But if you're trying to call top in this, we have two BOJ intervention levels. 152 was this recent high. This was from a couple weeks ago. That was a Friday afternoon intervention. This was a BOJ rate decision that came in on a Wednesday, Thursday. So it is somewhat random. It's going to be difficult to time. But again, chart alarm set at 152, chart alarm set at 144.671, just highs and lows. And watching everything, of course, this week to see if the JPY at that 0.25% 10-year yield continues to, drive us crazy. Watch the BOJ. You might have some crazy, ridiculous volatility at some point, So we've got to be watching this. But the bar count technically on the dollar yen is long overdue for a correction back into this 200 EMA. That's my moving target. I know that price, if it goes sideways, this will continue to move higher, and I realize that. But from the technical standpoint, I'm looking for this to make a pretty deliberate effort to come back into this 200 EMA, which is this red line on my chart. Okay. Any other charts? We can take a look at some other currencies if you want. If you want to take a look at some stocks, there's a couple that I'm interested in. This week, like I said, Uber reports earnings. I'll be watching this one. Pre-market at 27.38. I'd like to see if Uber has positive earnings, which maybe they do. I'm not sure what exactly they're doing to be a boost. Tech for the most part has been hit just really badly, right? I mean, Meta's down to 98 and change. Do I think that Meta's going to fill this gap eventually? Yes. I mean, we did buy some credit spreads on it. And again, we still have to be comfortable taking losses, right? I mean, if all of a sudden it's like, nope, Meta's going to be a $60 stock at some point, okay, I mean, then I'll take the risk. But I think we can fill this gap, which gets us all the way to 120. We did a 105 by 100 last week, and we're looking for this to give us a few bucks in income. Apple was the kind of the standing bellwether that didn't budge. So Apple had a nice rally off these lows. Apple did not break the lows back here in June, and Apple beat top and bottom estimates. But Google missed earnings, Amazon missed earnings, Microsoft missed earnings, and that certainly hurts. So Google is here at 95. 92. Oh, fudge. You know what? Well, we didn't take those. We did 95 by 92 50s. Let's see here. No, we've got 105 by 102 50s on Google. I'm just gonna wait and see if this. I mean, if somehow we have like another push downward on tech in general and that drags the markets, I'm way more interested in some ownership of Google at pre-COVID highs around 75 bucks. So I'm not done watching these, not by a long shot. And then Microsoft, same thing. Sitting at the weekly 200 EMA around 232. I like this pre-COVID high around 180. I mean, 200 bucks. If Microsoft comes down to $200, that is, to me, that's a bargain. Now, I might be waiting for that. Technically, it's about 45%. If I get that level, that's a 45% correction on Microsoft. I'm gonna take some trades on it. So right now, I'm waiting. I've got exposure in a lot of stuff. I'm in energy, I'm in financials, I'm in some tech, but tech at lows. I mean, we've been pretty patient waiting for some tech plays. We have some other stocks that we've got like, I don't know, probably 40, 50 positions running, and not all ownership, a lot of options. Let's see here. Pound yen, sure, we'll take a look at pound yen. Pound yen, so we broke above the 170 handle. We're at 171. On the daily time frame, let's take a look at this daily. So I'm pretty interested in the pound yen with this. If we get a trend line break on the pound yen, way more interested in looking for an alignment to sell. So don't call the top on this one. I think this is a volatile enough pair that if it does confirm, we have plenty of room to go a long ways down. We could have this. In fact, it kind of sets up like it's trying to do a rising wedge here. But the scary thing about the rising wedges is it looks really good, but if we don't break to the downside, this will just keep going, and just keep going higher. So don't call a top on that pound yen. If we can break this level, I would look for a break, a pause, and a go, or a break, a retest, and a go. Look for some type of flag pattern, some type of counter trend line break. That confirmation goes a long way in that pound yen. I think that's a pretty clean looking trade. But if you go to the higher time frame on pound yen, here's the weekly. We've been in consolidation for a while. Wave 1, 2, 3, 4, 5. Really squirrely here. You look left on this chart. I mean, where are we going? Are we heading back up into 175 or possibly 180? Maybe. Otherwise, I just see it being pretty choppy for the most part with high volatility. This could be a very high volatility pair where if we get this contained, break this trend line, look to bring this back into not necessarily the pound flash crash lows, but respect this past resistance over here, right? Past resistance around 160 to 156. So I mean that's over 1,000 pips to the downside. But all it takes is a little nudge, little confirmation, and trade some alignments. Okay. No, I didn't. I didn't even see that email actually. FXI crossing 21, IEF crossing 94.50. So that's good. 94.50. We got out of that at 95 by 94 last week. That's a what's the IEF is the 1 to 3 or the 7 to 10. 7 to 10 year bonds. So this trading at 95. We got out of this last week with a few cents profit. And then FXI is China large cap tech. This is down to 21 bucks at some lows. And we did a couple of these staggered credit spreads out through the end of the year into Q1, 28 by 27. We did get an assignment last week, but we took it for a small loss. This is one we ended up closing for a profit, actually. We were actually upside on the credit spread. The premium was worth so much that we closed out for like, a lot of traders closed out for like 10 cents or better. And it should have been a losing credit spread. So some pretty solid premiums on this China stuff, but super volatile. But no, I didn't get the email. I don't even think I saw it. Let me check it right now. Let's see here. Okay. Would you mind resending it to me like this morning and just put resend in the subject line so I can take a look at it? Cpulver at markettraders.com. And then really quickly on my end, today's going to be a ridiculous day. This week's going to be ridiculous. I have a course launch for market traders called Master Flex. Something I'm pretty darn excited about. I'll give you a little sneak peek if you're interested. Let me go to the charts here, get logged in, and I'll give you a little sneak peek. So we have a bunch of webinars, 11, 4, and 7, kind of the usual deal. And this is what it's going to look like. So you're going to see me talking about this. I can talk a little bit more about it in the Flex trading room. But basically what I'm looking at is this has been about 2 years in the process of me kind of automating a directional bias. Meaning that if I was never teaching direction or teaching structure, support, resistance, trend lines, I wasn't doing any technical analysis, this would be, to me, the safest way to kind of look and confirm where we can trade. So we have a dashboard that comes with this. You can choose up to 30 symbols. This includes also Forex pairs. You can use stocks and ETFs. You can use cryptos. So your favorite instruments right here for the dashboard. You can see what's all green, what's all red, and then of course go down to any time frame you wish to trade. But I'm pulling a standard directional bias using 8-hour time frames. That's my personal favorite. So it's a little bit faster and more nimble than the daily, but obviously smoother than the 1 hour and 4 hour, which can be pretty noisy. We have the ability to trade the safest and smoothest trends, and then we can get a little bit more aggressive with some very tight to price indicators, which I really like. So it's called Master Flex. It pairs nicely like fine wine and cheese, or peanut butter and jelly, or whatever your favorite combination is. Pairs really well with the trading room because this is something we'll be referencing on a daily basis. And I talked to the team internally last week, and I just said, look, I don't care if traders come to me with a demo account. They come to me with $500 in their Forex account, or they come to me with hundreds of thousands of dollars in their Forex account. If they've never traded a robot, you can trade a robot with this if you'd like, but obviously I'd like you to know the strategy and trust the strategy first before you ever deploy automation. But it's been, like I said, 2 years in the process, automating this, pairing this with automation for Forex trading, and also just using this on your favorite instruments. I mean, it's a pretty powerful combination to see how to trade it, where to trade it, and if 20, let's say just focus on currencies for a moment. Of all these, you're only going to get so many. We might have, like, let's say 8 to 10 currencies that are all lined up for green or all lined up for red. And these obviously mean something. So the buy zone represents one of these indicators, prices above or below it. The ribbon is my dynamic support and resistance. My trend finder and Heikin-Ashi, those are two aggressive indicators that are very tight to price, but visually gives us some great references. So I'm going to have a lot of fun talking about it this week. But like I said, I can share a little bit more in Flex. If you want to jump into a webinar, you're more than welcome to. Market Traders has webinars running all week. But I'll probably be co-hosting a lot of them so I can make sure the message is clear. And as always, since I'm the trader and course creator, I'm trying to set proper expectations where this isn't the holy grail. This is something I think is very useful in multi-asset trading. I think this is something I can teach anybody how to learn and how to master within a couple of weeks. Just give me some time and give me some commitment and dedication to it, and we can help you trade. So let's see here. All right, that's fine. Yeah, just send me another email if you want to. And then New Zealand dollar, we did that one, Craig, but I'll revisit that one for you. So New Zealand US dollar, I was looking for New Zealand US dollar was trading at 57.96, and again, it's all eyes on the Fed this week. So I looked at this potentially as a bullish pattern. Okay, now I said potentially because the dollar index is going to be the big mover this week. If we have a pullback and a rally, the Kiwi does have a lot of upside. So I'll say this, a weaker dollar this week, if the DXY is dropping, right, DXY goes down, I think the Aussie, I think the New Zealand, the Euro, and the Pound are probably going to be the four that run the most against the dollar. The dollar yen is probably going to be the most neutral because the BOJ is still super dovish, and so that one might have its own kind of rhythm. The dollar Swiss might do its own thing as well. Dollar weakness, I mean, I don't care if the dollar Swiss drops because I'm still going to stay long. Dollar CAD, we could drop. I mean, energy's been high. Oil's been decently supported around that $90 handle. But I think the Aussie, the Kiwi, the Euro Pound, they have the biggest squeeze potential against the dollar. So, and the reason I just say be careful on this one is because if dollar strength kicks in, this might look promising for a bullish move, but if dollar strength kicks in, this just goes back down and retests the lows. I'm still interested in buying this low because that's a COVID crash low from 2020, and I look at that as a pretty strong level of support. So there's really not a lot on the DXY that makes me want to buy it. I'm just thinking of the longer term. I say longer term, I'm talking like 3 to 6 months. If this dollar index, pushes up higher into this 120 handle, I'm still going to short this thing. From a position standpoint, I'm still going to short the dollar. The commitment of traders is super long in the tooth. It's like 80+% connected. I mean, that's a crowded trade. I think that the reward to risk is like 10 to 1 if you're willing to short the dollar. It's just you've got to, dollar cost average into it. You got to level yourself into it. So either we're hitting this major supply level from 2002, and this holds and does become a correction back into the 2000 or the 200 EMA. Shop at 35. Let's take a look at that one. So anyway, that's what I'm talking about. I mean, we got to watch the DXY. So if you're talking, New Zealand US dollar, watch the DXY. Yeah, no worries. Glad you're here. But it's all eyes on the DXY this week, right? So chart alarm set. Down here, set at the 200 EMA, set with this whole level to the upside. It just depends on if the Fed's gonna just kind of rain on the parade, right? I mean, the markets are looking for any reason to rally and sustain this run. We're sitting at 300 or 390. I think the SPY could get to 400 plus, and that is to me where we have some pretty heavy resistance. I mean, from a technical standpoint, running to 403 is great if we break, and it would make sense if we don't, right? I mean, we hit this level, nice run off the lows, but we still have to get through this rate decision. We still have to get through the midterms next week. We still have to get through a December rate decision. And I don't think again, the market is like, it just hasn't gotten over the hump of moving past the Fed, right? If this CME watch tool shifts a bunch, where we have, okay, so they raise rates 75 basis points this week, and then they shift it for December, shift it for February, March. If this keeps shifting, it's not going to go well for the markets. I think that it's pretty obvious right now that inflation is super slow to come down. It's coming down in certain areas, but when we're talking, food and energy, and it's like you look at PCE, you look at CPI. If you exclude food and energy, then we're kind of back to normal. A lot of things have come down to, pre-2020 levels. But if you include food and energy, guess what? Inflation isn't going away, right? And you look at people that are depleting their savings to maintain a standard of living. That can also be a problem. The U.S. debt is at $30 trillion. That's going to be a problem, right? So, I mean, we're just kind of masking the bigger problems for a later date. And, tell that to anybody that holds Bitcoin and they're like, I know, that's why I'm holding Bitcoin, right? Which is fine, but it doesn't mean that's a guaranteed solution. There's a lot of stuff that needs to be fixed. Inflation being one of them, and this is what I said probably a month ago. If the Fed's message is, we know that we're due for a recession, we're going to have a recession, we're in a recession, but we're trying to avoid a recession with high inflation, then they're going to stay higher for longer, meaning they're going to raise rates, market be damned, they're going to raise rates, and they're going to stay at 4% to 5%. Now, they're not going to like it, because at 4 to 5%, the public debt alone is going to be one of the largest line items for the U.S. government or for the Fed, which is insane, right? Because the bond yields at 4%, 5%, I mean, that's crazy. That public debt would be $1 trillion. Wow. I mean, it's unbelievable. So how high can we go and how long can we hold it? I mean, I listened to a couple interesting podcasts, a couple good speakers that are regulars on In Search of Green Marbles, which is from Weiss Capital Management. They talked about, could the Fed hold rates at 4 to 5% for 6 months? Yeah. For 12 months? Yeah. For 5 years? No way. Right? So, I mean, they can be higher for longer, but certainly not forever. And I think that's what the market just has to figure out. I mean, do we have a pause? Sure. I think it's certainly more of a pause right now than it is a pivot. I don't think the Fed's going to go backwards. I don't think the market's going to be given good news this week by, the Fed only raised by 50 basis points. I doubt that's going to happen. I think they're going to stay at 75. They're going to keep jawboning and talking down this. They're getting a lot of free mileage out of their restrictive words, and they are suppressing everything. And that's what the Fed wants, because they can still raise rates a little bit here and there, but if they get free mileage out of the markets kind of crashing on their words, then that helps them kind of achieve their targets, right? But the dual mandate of inflation and full employment has just continued to create all sorts of havoc for the Fed. Right. Yeah, good point. Craig says, what if something breaks? And we've talked about that. I mean, honestly, so here's the deal, right? And I'm going to end this session on this. If something breaks, I think the world is going to start losing a lot of faith, and the Fed is going to lose a lot of credibility. If all of a sudden, like something, look what happened to Bank of England, right? The 30-year bonds, if you go to GB 30-year, I think that's yep. So this was when the BOE stepped in. If this happens with U.S. Bond yields as well, then something's broken, and you're going to lose a lot of faith. The Fed's going to lose a lot of credibility. And look, this message is coming from the IMF. The International Monetary Fund is like, look, you idiots, stop raising rates as aggressively as you're raising rates. I mean, we're talking about some of the biggest jumps and hikes that we have ever seen in central banking, right? And is it actually raising rates is gonna help inflation? Not really, because inflation is a supply chain oriented problem. That's the genesis of it. There's clearly friction in the global economy. Food and energy is excluded in all these inflation measurements. And so what happens? We're having these crazy tightening cycles from these central banks, which is effing up the global economy. And this is what it looks like when something breaks. If this happens in the US, then something breaks, and guess what's going to happen? Something breaks, the Fed steps in, and nothing that they've said even matters, because they will step in and they will rescue whatever needs to be rescued, because we're not going to have, insolvency or bankruptcy. But from that, breaking is going to be something that is a high or low, and it's going to be awful, and it's going to be painful. But at the same time, if that's what has to happen, that's what has to happen. So do I want it to break? Of course not, because that just puts the whole financial markets in jeopardy, and it becomes more and more fragile as we move forward, because it's like nothing works without breaking, right? Or it's like for things to behave and align again, we have to have some type of crazy intervention and manipulation, where it clearly is not a free market. So yes, that is an alternative, that something can break, and from there we have a top or bottom, and things start to realign technically, because it's just forced manipulation. But if the Fed can somehow navigate an unbreaking, but I don't know. I think the Fed's mission is essentially impossible. But I hope we don't have to have another break. I mean, the Bank of England and the UK, it's one of the largest economies in the world, one of the most developed, largest economies in the world. And it almost broke, right? So it doesn't matter that the central bank is tightening and raising rates, because the Bank of England stepped right back in and just flooded the market. So the Fed may do the exact same thing, and all this talk and all this, tough talk and inflate, it doesn't matter. They're going to step in and prevent it from breaking, but it's going to get uglier and way more painful before they step in. So yeah, we'll see. And again, that's really this toss-up trade. Does something break, or do we somehow negotiate a smooth-ish transition from Q4 to Q1, or the market can kind of price in properly without having something break where the Fed is going to be over the next 6 to 8 months. And that's why we keep watching those yields. Watch those 2-year yields, 5-year yields, 10-year yields on the dollar. Watch the DXY. Those are the best correlations I can find to how we're going to trade the equities market. You want to see bullishness in equities, you got to see those yields drop. Period. It's not going to change. We're not going to see yields go higher in the stock market rally, not sustainably. You're not going to see a positive correlation with the equities market going up and bonds going down, right? I mean, the stock market going down and bonds going down. That's positive correlation. You're going to have to see a break. So either the bond market just turned recently. So TLT is the 20-year. We turned recently here. So either this heads lower, right? So if there's more pain in the bond market, then we should see equities rally, because they should not be positively correlated. But if we see bonds turning up, that probably means another painful spike to the downside in equities. So it's not that hard. I know I'm throwing a bunch of stuff out there, but it's like, look, watch yields. Watch the yields, watch the DXY if you want to try to time something with some bullishness in the dollar. Last week, Apple pretty much saved the market. I mean, it's ridiculous, right? Apple had enough to kind of keep the SPY afloat. We had decent earnings for the most part of 700 plus companies last week. This week we have over 1,000 companies reporting earnings. So we still have yet to see the big earnings compression. It may happen, but there's also a lot of cash and a lot of buybacks. Energy companies were raising dividends, buying back stocks, so that keeps things floating for right now. Yeah, but there's just stuff to watch, tons of stuff to watch. Okay. All right, buddy, I'm going to wrap it up for today. That was a pretty long session, but here's the deal. So Wednesday, 2 p.m., join me for the Pulver Report here at the YouTube channel, youtube.com/Chris Pulver, 2 p.m. Eastern Time. We'll trade FOMC together. Friday for recap. If you'd like to join me this week in my trading rooms, Flex Room, Tuesday, Wednesday, Thursday, Equities on Demand, Monday through Friday. I'm also going to be in a bunch of webinars this week talking about my Master Flex. Excited about that class and rolling that thing out. And like I said, that'll pair nicely with my trading room and moving forward into 2023. And let's have a good week. It's going to be a crazy one. All eyes on the Fed. I hate saying it, but that's what's going to be the reality. So we'll see you then. Okay. Take care. Bye.